Is this consumer confidence slump irrational? Can we trust the stock market rebound we're seeing right now? And what will turn around the stock market sustainably? I'm Peter Switzer without Paul Rickard, but we're still mad about money. Okay, let's look at this consumer confidence number from ANZ and Roy Morgan. It came out with a value of 89.3, down for the fourth week in a row. 89.3, and the long-term average for confidence is 112.4. So therefore, we are down and we are negative, and the cause is all this speculation about rising interest rates. And the scariest one at the moment is Westpac's chief economist, Bill Evans. And Bill is telling us that the June interest rate rise, wait for this, is not going to be 0.25%, but will be 0.4%. Now that's really going to hit a lot of people who are worried about their mortgage repayments already. Most people can kind of say, oh, I'm ready for 0.25, but 0.4, I hope Bill is wrong on that point. I hope the Reserve Bank is a little bit more steady and goes by 0.25s to look at what is actually going to happen to inflation. But out there against Bill's big call is Matt Comyn. Now, Matt is the CEO of the CBA. They are the biggest lender of mortgages in the country. And his economics team thinks that the cash rate will get to about 1.3% by the end of this year, which is a lot less than 2% or even higher from other economists. So 1.3%. So that is much more measurable. It's a more measured kind of rise. And I think that's going to be really important, how the RBA handles it. So I think a lot of this consumer confidence dropping is understandable, but it may well prove to have been irrational, primarily driven by the excessive calls by many economists out there that the interest rate rises will be a lot more than they actually will turn out to be. I hope Matt Comyn and the CBA are absolutely right on this subject. Let's go to what will turn around the stock market sustainability. And I think comments like Matt Comyn's, and there are US equivalents saying the same kind of things, that the Fed isn't going to raise interest rates as rapidly as the bond market and some economists are saying. Also, we've got the good news this week that China is talking about going out of lockdown by June 1. That's definitely a positive for the stock market, and it's helped the current rebound. Then Goldman Sachs and the bond expert there was interviewed on CNBC this morning, and he was basically saying that the US bond market's gone a bit over the top, and he's expecting that we'll see bond prices actually rise and yields fall in the not too distant future. Good sign. That would be absorbed by some people out there who are key influencers of the stock market, and explains why the Dow, the S&P 500 and the NASDAQ were up pretty solidly this morning, and I'm sure our market will benefit from that. We've also got the fact that if you look at the last unemployment or jobs report coming out of the US, wage rises are starting to slow, and we're seeing things like used cars in America, the price rises are now starting to fall as well. Things are starting to move towards normalcy, though I think normalcy is still a long way off. The bottom line is a lot of smart people in America are starting to believe that inflation is peaking, and that's going to be a good thing for the stock market as well. So let's go to my final topic. What will turn around the stock market sustainably? Well, the big one now, given what I've said before, Ukraine, the war, the quicker that's over, the quicker we see peace, the better the stock market reaction will be, because that will bring down the price of oil and help inflation come down. And other commodities as well, their prices have gone up because of the Ukraine war, and therefore if it stops, then we have a big pusher on inflation being taken out of the mix. Then we've got the fact that China's talking about coming out of lockdown. That's another thing. As they come out of lockdown, they manufacture more stuff goes to the world economy, supply chain problems become less of a problem, costs come down, good for inflation as well. Then we've got the fact that you put together all those things I've been talking about, and they are actually, we start to see inflation numbers actually coming down. That will give the stock market a real lot of confidence, because a lot of stocks, like tech stocks, have been sold off because of the inflation impact on interest rates. Because when inflation comes down, then the market will start saying to itself, if inflation's coming down, then all those rate rises we expected may well have been exaggerated. There won't be as many as we thought 3 or 6 months ago when the sell-off started in early January. So the very realisation that the sell-off was driven by excessive fears about inflation and interest rates will also be a self-fulfilling benefit to the stock market. People start saying, oh, we oversold, we better start buying. Then the market sees a lot more buying and the market goes up, and guess what? The stock market rises as a consequence of that. That's what will result in a sustainable change in the stock market. And so we've got to keep our fingers crossed that inflation starts coming down over the next 3 months or so. That's when the interest rate scenario will change to a less negative one, and that's when the stock market can really go. I will be surprised if we're not seeing a much stronger stock market by October, November, setting us up for a nice Santa Claus rally after the midterm elections in the US, which is often the case. History has shown it's a great time to invest. Straight October 1 of a midterm year, rolling all the way till about December 1 of the presidential year, which is the 4th year. So that's my best case scenario. I'm Peter Switzer, and I'm mad about money.